Good afternoon. Yes, sir.
So let's give it a couple of minutes and then we'll start by the time the rest of the people can join in. Yep, I think we can start now. So welcome everyone to today's session on the consulting strategy frameworks. We are going to discuss about very important frameworks, and that's going to really come handy with respect to your case study round and then for a consulting position. So we'll start with why frameworks are important. We'll discuss what sort of frameworks are usually get utilized in a day-to-day life of a consultant. And then we're gonna focus a lot more amount of time in understanding the 8 types of frameworks, where we are gonna try to understand them using a case study for each of those frameworks. So that's gonna put things in perspective. So starting with why frameworks are important. So utilizing a strategy framework in consulting industry is crucial for several reasons, I would say. Firstly, it provides a systematic approach for consultants to analyze complex business problems, helping them understand the intricacies of a client situation. Secondly, it serves as a guide for organizing information, ensuring a comprehensive and structured analysis. Moreover, strategy frameworks aid in identifying key issues and opportunities, enabling consultants to formulate well-informed recommendations. They enhance communication between consultants and clients by establishing a common language and understanding of the strategic landscape. Overall, the use of strategy frameworks promotes consistency, efficiency, effectiveness in consulting engagements, which leads to more successful outcomes for the clients. Yep. So before we go ahead and talk about the 8 key cases with the framework usage, these are the 4 very basic frameworks, and I'm sure you guys must have stumbled upon it at some point in your life. So we'll just quickly skim them through, and then we'll talk about the 8 cases. So SWOT, everybody knows, is used for strategic planning and decision making in various organizations, which factors in both internal as well as external perspectives. Internal are your strengths and weaknesses. External is your opportunities and threats. Porter's 5 forces, again developed by Michael Porter, that helps analyze the competitive forces within an industry. So these are the 5 forces which takes into the account while performing this analysis. BCG matrix, developed by the BCG consulting firm, is used for portfolio analysis, helping organizations assess and manage their product and service offering. So here, if you analyze a company's products, if let's say a company is having say 10 products in their product portfolio, so each product it has to go into one of the 4 quadrants, and basis whatever quadrants that they are going into, the product level strategy will get devised. McKinsey's 7S framework, another framework developed by a consulting firm, is used for organizational analysis and strategic planning. So these are the 7 aspects that the framework considers while performing a analysis. Yeah, but the most important frameworks are these 8, especially with respect to the case study round. More often than not, the candidates are asked case studies basis one of these cases or frameworks. So let's pay very you know we're gonna place a very significant amount of time on each of these frameworks. So feel free to ask any questions that you may have. Otherwise, we'll obviously take questions towards the end of the session. So starting with profitability optimization. Now, if somebody asks you, then how to increase profitability, right? So there are largely two ways to do that. Either you increase your revenue or you reduce your cost, right? So these are the two legs to increase the profitability. So first, let's talk about the cost aspect. So here we'll focus on the expense analysis. So on your right hand side of your screen, there's the case, right? So using this case, we'll try to understand how to go about it. We are not gonna solve a case, but we'll try to understand it's the approach part of it, right? So here the case is the client is a low cost airline based in Hong Kong, serving 18 destinations in the Southeast Asian market. The airline's profitability was strong until 2018 and has since seen a declining trend and is now just barely profitable. The CEO would like you to determine what is causing the profitability decline and suggest a strategy to reverse the trend, right? Straightforward case, the company's profitability is going down, and your ask is to come up with the reasons why this is happening, right? So this is the case. Let's see how we go about it using the expense analysis. So first step, we need to gather the current expense breakdown, right? So for an airline, there'll be multiple cost line items in their income statement, right? So we need to understand at each line item what is the breakdown, right? So how much is, let's say, the lease rental the airline is paying to the plane manufacturers like your Boeing, Airbus, right? What is the lease rental? What is the staff salaries? What is, let's say, the fuel cost? What is the demurrage cost? So people who are not familiar with the aviation industry, demurrage cost is basically a rental that the airline has to pay to any airport where they are parking the plane. Let's say when Etihad plane is coming to Bombay Airport, in that case, the Etihad Airlines will have to pay the rental amount to the Chhatrapati Shivaji Airport terminal, right? For however long the plane is, being parked at the airport. So that's nothing but the demurrage cost, right? So and there'll be multiple cost line items, right? And then you may be asked a similar sort of question, case with respect to any industry, right? So for any industry, those cost line items will vary, but the larger picture is we need to get the entire expense breakdown, right? So for the current year. Now, in order to understand the trend, like what has happened historically, only basis that we'll be able to know that whether the profitability is declining, whether costs are increasing, revenue are decreasing, whatever may be the case, right? For that, you need the historical expense breakdown as well, right? So we need to understand both current as well as historical expense breakdown. First step. Secondly, we need to identify the bang area. Remember the Pareto principle. We need to see that out of, let's say, if there are 20 cost line items in a income statement for, say, this airline, we need to understand which are those, top, let's say, 3 or 5 cost line items which are contributing the most, which is nothing but the bang area. So that's something we need to identify, because from a coverage standpoint, it's not practically possible that you go on and analyze each of the 20 cost line items, right? So instead of doing that, let's try to focus on the cost line items which are of the significant importance to a company. Next is we need to analyze key fixed and variable expense components and identify any meaningful changes in the expense areas, right? So there'll be expenses where you need to clearly uh, uh, segmentize both the set of expenses, both fixed as well as variable. by knowing that, you would be it becomes a little easier, right, to to come up with a strategy. For example, say for an airline, they have to pay the lease rental every month, right? That means it's a fixed cost for the airline, and there's hardly something that you can do about it. So think of COVID scenario, right? When the COVID struck, all the airlines had to halt their all the aircrafts to respective airports. But at the same, that means there was no revenue inflow coming in. But at the same time, they had to pay the lease rental for the aircrafts that they have leased from the airport, the aircraft manufacturing companies. They had to pay the demurrage cost to respective airports wherever the planes were parked, right? So companies were incurring significant amount of cost, and hence you must have read in the newspaper that there are a lot of airlines were on the verge of bankruptcy, and there were in fact so many cases where airlines went in fact bankrupt. That means they were incurring fixed expenses, something out of control for them, and there'll be certain variable expenses like your fuel consumption, right? So only if the aircraft is in service, it's gonna consume fuel. Otherwise, it's not, and hence it's a variable expense. So I'm just trying to give you all an example, but that can vary from industry to industry. But that's something you need to understand, that the fixed as well as the variable part of it. And then once you're done, doing the analysis at a company level, also try to see what is happening in the competitive space, right? What the other peers are doing, where the company stands with respect to the other competitors. So request information on the competitor cost structures from the interviewer to see where the company's cost structure may be inefficient. So by doing the benchmarking, by comparing your company's cost line items to the other companies, you'll be able to know that, okay, this is, let's say, X amount of lease rental is being paid by say Etihad, right, for let's say 50 aircrafts. At the same time, for 50 aircrafts, say Emirates is paying say much lower amount for those aircrafts. Now for the assuming the for a similar level of specs for those aircrafts, if that's the case, then you know for a fact that there is a significant room for an airline to negotiate terms with the aircraft manufacturing companies, right? So that's one way to go about it, and hence it becomes important that you compare the company's cost structures with the competition. Now, it may not always be possible to get that information, right? So it's not always that you'll get the information or at a cost line item level from a competition. So the interviewer probably say that, okay, that information is not available, and then you can go on with your analysis. But just by asking that, it gives an idea to an interviewer that, okay, you're not only thinking about at a company level, but you're thinking holistically, right? So the idea is to put a perspective in front of an interviewer that you have thought about these things, which are very pragmatic in nature, and hence you know what you're doing, right? So that's the overall idea. Next is revenue analysis. Again, let's try understand this using a case. Here the client is a market leading niche skating equipment manufacturer based in Stockholm. Profitability has remained steady, but the CEO has noticed from reading industry annual reports that two publicly listed competing skating equipment manufacturers have meaningfully higher profit margins, have also been increasing their top line, which is nothing but revenue. The CEO would like to understand the drivers of these differences. Again, similar situation where the company uh, has realized that the competitors are doing better. They are having higher profit margins vis-a-vis the this particular company, right? So now in the previous one, we understood, or we approached the case study from an expense standpoint. Here we are going to focus on the revenue. Now, revenue has two parts to it. How can you increase the revenue? Either, so revenue is nothing but a function of your volume as well as price, right? Now, either you increase the volume while keeping the price constant, you can increase the revenue, or you keep the volume at the same level and increase the prices. right? So these are the two ways to increase the revenue. So now, what all things which are important here? Again, we need to gather the detailed information as possible on current sales volumes and pricing, and historical volumes and pricing, right? So we want to see that historically what has happened to volume as well as prices. Use this information to determine growth rates. We need to figure out what is the CAGR, at what rate the volumes or the prices have either gone down or gone up. Yeah. We need to also identify the bank areas, right? So there may be possible that there are multiple, revenue streams. So there are, say, multiple products the company is offering. In that case, we need to see that at a product level, what has happened to both volume as well as prices, right? So for this particular company, say skating board is one equipment. Say it may also be selling those helmets or other the knee guards, right? Elbow guards, etc. So we need to see what is happening at a product level for the revenue, right? And then we'll be able to determine that, okay, what is my bang area? That means what are my top 3, top 5 selling products? That's where our focus is going to be. Then analyze the key product areas, identify any meaningful changes in volume and prices. For the identify, say, top 3 products, we need to understand what is happening with respect to their volumes and prices. Once you're done with doing the company level analysis, similarly, we need to see what is happening with respect to the competition. Where are they standing? What is happening to their volumes, their prices? Is it the fact that prices for all the competing players, they have increased the prices following inflation? If that's the case, then there's something out of control for the company. If something is happening with respect to volume, if the competition is able to generate more volume, that means there's something different the other peers are doing, and hence they are able to generate the higher profit margins. What is the case is something we need to understand, right? So this was the profitability optimization using both expense as well as revenue. I'll take a little pause here just to see if there are any questions, doubts. Otherwise, obviously, we'll keep on taking questions, uh, you know, even at the end of the session. Are we good? Okay.
Hello.
Yeah, yeah, go ahead.
Hello, Mahesh. Like if we are, we saw in last, like last month, before last month, one of the data is can the Zomato's income is coming from the fixed FD.
Yeah,
Basically, the income coming from the FD. Not
correct.
that there is the product is from the like they are delivering the foods, not
Hmm,
coming from this background. They come from the FD background. So
hmm,
how can we justify like these type of cases if they come in future? Definitely, how can we tackle these type of questions in
sure.
future?
Yes, really good question. Thanks for asking it. In fact, this was in the news, and I hope all of you must have read it. So, what has happened to Zomato is it was reported that a significant amount of their revenue is coming from the other income. Right. So, when you have operating income, the second is other income. Now, operating income is something where the company is generating revenue, selling the core products. Right. Other income, for any sort of revenue stream which is not coming from the core products of or services of a company, that is called as other income. Now uh, Zomato has invested a large chunk of their amount in FD, right? So fixed deposit interest is something they are earning from those deposits, and that amount is becoming significant. And there was another component as well, that Zomato has also given deposits to many of their group companies as well, and hence they are taking interest from there as well. Now, let's say you've been asked to uh, uh, assess, say, profitability, how to optimize profitability for Zomato, right? So now, from, let's say, a revenue analysis perspective, right? So you need to determine that, okay, what is the percentage of the income is coming from operating income? What is the percentage of income coming from other income? Now, let's say that other income is coming to say 10% of the total income for Zomato, right? So now you need to focus on the increase, how to increase the revenue by keeping in mind that 90%, because Zomato as a company doesn't need to focus on increasing the other income, right? If that is the case, let's say if, and then that is actually the case for, so many companies, their other income is forming to say 30-40% of their total income. That means it's a red flag, right? That means company is not focusing enough on, generating revenue from the selling, core products or services. They are using, they're getting the income from the other sources, which are not consistent and which are not reliable, right? So that is one point that you can bring up in the, case discussion as well. Your focus has to be on the how to increase the, revenue, uh, uh, and that is the operating income. That's where the focus has to be, right? Hope that answers your question.
Yeah, okay, thank you.
Yeah, no worries. Okay, we'll move on. So next is pricing, right? So we were discussing about the revenue analysis. Now, how to increase the revenue? There were two legs to it. One was a volume. Second was price. Now, this will focus on the pricing bit of it. So here, this is the case. A long stay hotel chain would like to maximize profitability by determining the optimal pricing for different lengths of stays and types of rooms. So that's a straightforward case. So assume, in fact, let's not assume, there's a reality, right? There's a lot of uh, uh, religion tourism which is taking place in Ayodhya, right? Following the construction of Ram Mandir, and hence a lot of hotel chains are coming up with their hotels in that region, and hence that from the accommodation standpoint, it's a booming market, right? So there, let's say a hotel is coming up, and then they want to assess what is the price that they should keep, right? So what are the factors that you should factor in while coming up with the pricing? Now, there are again two approaches to it. One, you can focus on the expense or the cost part of it, and the other is the focusing on the customer part of it, right? So we'll try to understand using both. So first, we'll talk about expense one. So here we need to understand what is the fully loaded cost for the client to produce product or offer service, right? So here we need to understand what is the cost of running a hotel, right? So that's something I need to come up with. Then I need to compare that cost with the price, whatever prices that I intend to keep. So here, let's say it's a 4-star or three, let's say it's a 3-star hotel, right? So whatever, and then if let's say I'm keeping the price as say 6,000 for one night, and let's say my fully loaded cost for running that entire hotel, that is coming to say 7,000 per night. If that's the case, that means the prices are not sustainable, and hence you know for a fact that you can't go ahead and keep the price as 6,000, since your fully loaded cost, which is higher than the price, it has to be lower than the price, leaving the room for the margins for the company, right? Secondly, we need to understand how does the client's fully loaded cost compare with the competitor pricing, right? So let's say the the Leela is setting up a hotel there, right? And their say fully loaded cost per room for a night is coming to, let's say, 10,000, right? And then they operate in say 5-star hotel category, right? At the same time, let's say Oberoi also coming, right? And for an example, they are keeping the price at let's say 9,000, which would definitely not be the case, because they are usually having, they're usually very premium, right? But just to give an example, if my cost of running a hotel per room is higher than the pricing of the competitor, that means that is not sustainable. There's no way that I should open the hotel over there, and this or everything is happening beforehand, right? We are doing this analysis before you go on and set up the hotel there. That way you know for a fact that okay, what are the pricing I'm gonna keep, is it sustainable? If it is not, then there's no point in opening a hotel and incurring huge amount of capex and as well as opex, and hence we need to do this analysis. In situations where the client's cost is higher than competitor's price, it is usually recommended to exit this product or service unless there's a clear path to reduce the client production cost or the competitor price is temporary or unsustainable. So we need to understand these two, right? So if that is the case, if your cost of running a hotel is higher than the competitor's price, we need to understand going forward, am I going to be able to reduce my production cost or say running the hotel cost? Let's say I'm say establishing a hotel, right? In order to let's say run a restaurant for my hotel, I'm procuring goods from say traditional market. But as I spend time in the city, I'll be able to know the different rates, different vendors from where if I procure from those vendors, it will be cost effective for me. So going forward, my cost of say running a restaurant would be significantly less than what it's gonna be in the initial days. If that's the case, then yes, going forward, your cost of running the hotel is gonna be low, and hence you can go ahead and continue offering the services. Or say competitor price is temporary and unsustainable. Let's say the other hotel was running say campaigns, and they were offering significant amount of discounts at a time, and hence their prices were lower. But that's not gonna always be the case, right? So going forward, their prices will come back to at a regular level, and hence you probably don't have anything to worry about. So that is one approach. In the second approach, we need to understand how much would a customer be willing to pay for this product, and how do you know that the how much customers are willing to pay for say a 3-star or 4-star hotel with a given level of amenities, right? So that's where you usually outsource this such sort of task to the research companies. So what they do is they do a sample survey. They they go in the market and they really ask the question, okay, if this is the level of amenity, this is the location, this is the star, what 3, 4, 5 star, how much is the per night room rental is something you are say ready to pay for, right? So that's where you get an idea that okay, this is the expectation from customers. They are expecting say a certain x amount for a rental, and that way you can then go on and take a decision whether to operate a hotel offering that price or not. We also need to understand what is the current state of demand and supply for the product and services. Continuing with the same example, is it the case that only during, say, holidays like Ram Navami or other major holidays, the tourism will be there, or is it the fact that the tourism level is going to be very high throughout the year? So we need to understand how sustainable is the demand. Also, we need to understand how many hotels are coming up with newer properties within the region. How many are existing hotels providing similar level of services, similar level of amenities, something we need to understand. What are the alternatives for the customer and the relevant prices? Is the threat of substitutes substantial, or can it be mitigated? So we need to understand all these things while coming up with the recommendation for the pricing optimization. Next is industry landscape and competitor dynamics. So we'll first understand
Hello,
the.
hello,
Yeah,
Mesh.
hi, hey, go ahead.
Yeah. Actually, I have two questions regarding the price
Yeah,
optimization.
yeah, yeah,
Basically, as far as the price optimization is concerned, you have taken example of the service sector, basically.
yeah.
And as far as the other industry like FMCG and
Hmm.
others, fashion industry, these things, the price is so you can say if any. changes in 1 rupees in change in FMCG, that means a huge, you can say the loss will face the company definitely. We can take example Parle-G. Parle-G,
Mm.
it was the previously price 5 rupees, and but the packet was too large as far as the now is concerned.
Right.
So that they basically did not change their price, but they change the product, like
Yeah.
shrinkflation
Yeah.
in economics terms.
Correct.
But as far as the price is concerned, so how different from the industry to industry varies, and how we solve the client problems regarding the in future. Like if the market is other India's about outside India's, the different price
Yeah.
will be different. So that
Correct.
how we have to any like database do we have to analyze any, like we have to any research on the market or whatever we have to.
Right. So, first of all, very relevant example that you cited there. We'll talk about it. But then to answer your question first. Uh, See, price sensitivity is something that varies from industry to industry, right? So usually, the price sensitivity is very high with respect to staple products, right? There's something the day-to-day items which are getting used by a mass market. One example that you cited was Parle-G biscuit. So any such product and in falling in this particular staple category, which is usually a price sensitive market. India in general is considered as price sensitive market. So like you said, Parle-G used to offer their biscuit packet in 5 rupees, say 20 years ago, and they are still doing the same by decreasing the quantity. Right? That's you rightly said, which is nothing but shrinkflation. So this is one feedback that Parle-G got, and that exactly what we were talking about, right? We were talking about the customer-driven pricing analysis. We talked about this, how much would customers be willing to pay for a product, right? So they did that. They ran a sample in by increasing a price, but they figured out that okay, people probably are not ready to purchase their product more than 5 rupees, right? Because they are aiming at a mass market, and for them, increasing the price even by 1 rupee is gonna put a lot of dent to their income statement, right? And hence they decided to go back to the previous pricing by reducing the quantity. They basically wanted to increase their profit, right? Against the rising inflation. So by not increasing the price, but by reducing the quantity, they were able to do so, right? So you have to be very cautious with respect to what is the approach that you should opt for, considering the type of product that you're analyzing, right? If you're analyzing a product like say, and then even Maggie did that, right? They did the same strategy. I think there are so many companies which have followed this particular strategy. So you need to understand what is the product category, and for that product category, how sensitive people are with respect to the pricing, right? So products which are appealing for a mass market, there the price sensitivity is usually high. For product which are say sort of premium, there the price sensitivity is not that much, right? So that is one thing that you should keep in mind.
But we usually see in like the in developing economy, basically they are
Hmm.
facing these type of things, and these type of things like we take example South Africa, other neighbor countries also facing these type of sensitivity, price sensitivity.
Yeah.
So that we have to restructuring the things if we are analyzing the companies, and we have to restructuring the products and analyzing again and again and every year frequently. That's I think client should do, for the client we have to should do.
Yeah, not really. So if let's say your product is falling under the staple sort of product category, so over the years, the people's perspective towards that product category is gonna remain the same. Right? It's not like the one thing that you're finding today costly that tomorrow probably you're not gonna find it. Usually, I'm talking about for the mass market, right, where the income is not rising, as fast as for let's say the upper middle or upper middle class, right? Their wages are almost similar to what they were, let's say, 5 years ago, right? So there's no real increment, I would say, in this particular mass market is getting, and hence their perspective of uh, their way of looking at product category is largely is gonna remain the same, be it India, be it any other country, right? Even I'm considering the developed economies as well, right? So product category, which is staple, there the and I'm only talking about the mass market, right? Their way of looking is largely similar. It's not that every year you'll have to do the research. Is not the case. Probably once in say 3 years or 5 years is still fine, but every year is not gonna change. And the country specific problems that you just cited in the developing economies, there is I would say a case for them that these countries are usually little more price sensitive, but I would say the focus has to be on the product category, right? It's not that in India, not all products are price sensitive, right? If you're going to say buy, let's say, AC, right? So now, let's say Samsung was selling AC for a say particular variant in say 30,000. If they increase the price to 32,000, I'm not sure people who are willing to buy that particular AC, they're gonna be bothered by 2,000, right? The person who can afford, AC previously 30,000 is gonna is not gonna mind, spending a couple of thousands more. So you need to
Yes.
understand what is the product category, right? And that is super most important, and
Mhm.
how price sensitive that product category is. Make sense?
Got it. Got it.
Yeah.
Thank you.
Cool. Okay. Yes. Coming back to the market industry landscape, here the case is the client is a large nutrition, health, and wellness company is considering divesting its non-core infant food subsidiary in order to free up the capital to invest in higher growing industries. The CEO would like you to assess the industry landscape of the infant foods business in Western Europe, right? So here the company is sort of a conglomerate. They are existing into multiple industries. One of them is the infant food category in which they exist. They want to divest it. That means they want to sell it off that particular business. Before they do that, they want to fully be sure that okay, this is the market which is no longer attractive to them, right? And by selling that particular business, they want to free up the capital in order to invest in the other higher growing industries, right? So that is the ask. You need to understand the infant foods market, and by understanding the market, this is going to be the decision of the company whether to sell it off or not, right? So what are the things that you should consider while understanding a market? First, you need to understand what is the market size, right? How big is the market? At what stage the market is it a booming market? Is it say mature market? So that's gonna have a huge impact on the decision the company has to take. And also, by understanding the current market size, at the same time you also want to understand what has been the historical growth or degrowth for the market. And so you that way you'll be able to know whether the market is booming, maturing, right, the declining stage, whatever may be the case. And at the same time, you also need to understand going forward what is the expected growth rate at which the market is gonna grow, because there lies a room for this. If the market is gonna grow at a significant rate, in those markets, all the players existing in that market get benefited. For example, the quick commerce market is growing at a rapid pace, right, in India. So whatever players which exist in this particular market, all of them are getting benefited, right? So if the market is growing, whatever company which exists in that particular market is gonna get benefited, and that is most likely the case than not. It's not always the case, but it is true for most players exist in those particular markets. We also need to understand what is the customer mix, what is my customer say segmentation. So say for this infant food market, my target uh, customer would be the parents, right? So you need to understand what is their perspective towards this particular company for the particular product category, which is infant foods. I also need to see what is the industry-wide profitability, right? So I need to understand who are the players which exist in this industry and what is the profitability level that these guys operate at. And I need to compare obviously with the this particular company to know that whether the company is lagging behind those peers or say at par or even above those peers. I need to also understand that what is the M&A activity in the industry. For example, if a consolidation is happening within the industry, the larger players are buying the smaller ones. If that is the case, then there's a very significant room that there'll be a lot of opportunities where the bigger players can buy the business that you're trying to sell, right? If the M&A activity is higher. If that is not the case, then that really becomes difficult to sell off the business. So there's something you need to understand. We also need to understand what is the competitive advantage or barriers to entry. So there are certain industries where there's a significant higher barriers to entry. For example, airport, say manufacturing, sorry, aircraft manufacturing, right? So you only have a couple of companies. You have Boeing, Airbus, right? There's hardly any other players which exist in this particular industry. That means there's a very high barriers to entry. And if you are operating in one of those industries where barriers to entry is very high, in that case you have to probably think twice before exiting it, because entering it is going to be really difficult, right? So there's something you need to factor in. Supply chain, you also need to understand who are the key suppliers to the industry, if it is relevant. So here, the idea is to look at what is the bargaining power of supplier. Remember the Porter's five forces. We need to understand the bargaining power of the suppliers. Let's say if there are very handful suppliers, in that case, we don't have the power to negotiate rates. It's the supplier-driven sort of market where they have the edge, right? But if that is not the case, you have multiple suppliers, perfect competition. In that case, you hold that power of bargaining power. So that's something also very important before you take a decision whether to sell off the business or not. We also need to assess the brand loyalty, right? So say if and then that again that varies from industry to industry, the brand loyalty. So if there's a very high brand loyalty, in that case, again, it's a one of the significant factors that you should factor in. Say brand loyalty is very high in the say soft beverages industry, right? So a person usually either is a Coke person or say Pepsi or say Thumbs Up person, right? In India. So if that is the case, there's a very high brand loyalty. Wherever you go, you'll always gonna prefer your preferred, say, soft beverage, right? You usually stick to that. So there's a very high brand loyalty. If that's the case, then one has to think twice before exiting the business. Technology, regulatory issues, or other key topics relevant to the markets, right? So we need to assess these factors as well. If there are, let's say a new budget is coming up, right? And then you get a hint that okay, there is going to be certain favorable policies which are going to come into effective say in the future. If that's the case, then you should probably hold off the decision to sell off the business, because going forward, if the policies are favoring this particular market, then there would be, multiple opportunities for the company to grow this particular business. Same goes for technology. If things are getting innovated and you have confidence that okay, your business would also be able to keep up with the changes, technological changes which are happening within the industry. If that's the case, then you should probably hold off the decision to sell off the business, because there won't be probably many players in the market who are innovating the way the market leaders are, right? So if that's the case, then again you should hold off the decision of selling off the business. So these are the factors one should consider while understanding the market landscape for cus- so this is one aspect. Second is the competitor dynamics. So here again, let's understand it using a case. Here, a client is a global financial services firm that is considering allocating more resources to the facilitation of electronic fund transfers globally. The CEO would wants to say better understand the market landscape and develop a strategic plan to increase the company's share of the market. Think of it, uh, the time when Google Pay entered the Indian market, right? So let's take that as an example. They wanted to, let's say, understand the Indian market landscape for this particular industry, and obviously they would want to increase their market share eventually. So what all things that you should consider? First, you need to understand who are the key competitors in the market and their strategies, right? So you have your PhonePe, Paytm, and other UPI players along with Google Pay, and you can see what all they are their strategies. Like, are they offering a lot of coupon codes? Are they offering a lot of discounts? Are they offering cashbacks? There are so many strategies, right? These guys are coming up with. There's something you need to understand. What is the current market shares and shares over the time, right? So what is the market concentration? I would say there's something needs to be understood. uh, so we already know for a fact that okay, the Google Pay and Phone Pay both put together, they account for more than 70-75% of market share, right? So that means that is a very high market concentration. So that's something we need to understand. But if the market concentration is not high, if the market is very fragmented, in that case, there is a probably very significant room to gain the market share. If the market share is concentrated, it becomes relatively difficult to snatch a market share from an established player. If the market is fragmented, there lies a very big room to gain the market share, and hence you need to understand what is the market concentration level. What is the product service differences among the competitors from the players which exist? Is there an edge for these particular companies? Let's say WhatsApp Pay, right? So WhatsApp has an edge, right? They have something which the other players don't have, because they are already people are already using that particular platform for chats, and at the same time they are also offering the payment services. That is the product differentiation which is there with respect to the vis-a-vis the other competitors. Any recent moves, threats by a key player to market or new entrant, right? So that's something again you need to understand. If the existing or the new players are coming up with a new strategy to gain the market share. Here, we also need to understand the regulatory aspect as well. And again, you must have read this in the news that government of India has come up with a directive that no UPI companies can hold the market share more than, say, I think it's 50%, right? So you also need to keep a track with respect to what is happening with respect to the regulatory landscape, right? So these are the factors one should factor in. I'll again take a pause if there are any questions. Okay, hoping you're good. So next is new product or project. Here in the case, a client is a durable consumer equipment manufacturer attempting to develop a green washing machine that employs special technology, resulting in 60% less water use and cleaning 10% more effectively than the standard washing machines. The CEO would like help to determine the product's market potential and the strategy to bring it to the market. Right. So again, a straightforward case. Assume the let's say Samsung has come up with the green washing machine. They already have a traditional washing machine. So the new washing machine is using the less water and it's also at the same time more effective. So what all are the areas that we should factor in? First, we need to see will the company have any competitive advantage that prevents competitor entry, such as a patent or a way to lock in customers once the client has unveiled the new product, right? So is it the case that the Samsung has developed a washing machine and they do hold all the IPs, intellectual properties, with respect to this product? If that's the case, then that gives Samsung an edge, right? Because nobody can copy this particular technology and make a product and sell it as a competition to this particular product. We also need to understand how is the client's product different or better than the competing products. What are the substitute products? So we already know this particular product has two, I would say, USPs. One, it is using way less water. At the same time, it is more effective. Right? So that's how the product is superior with respect to the other traditional washing machines. What are the pros and cons of the client product? For example, environmental and social considerations. So here we already know that since it's using less water, that means it's environmental friendly product. But there's just one pros. We need to do the entire comprehensive pros and cons analysis, because it may be possible that it is using less water, it is more effective, but it may be using more electricity. If that's the case, then that is one of the cons. So we need to understand all the pros and cons for a client's product. We also need to understand, is there a risk that the new product will cannibalize another of the client's products? Now this is a very important concept, right? The cannibalization. So here the Samsung is already having, say, a traditional range of washing machines, and now it has launched the green washing machine. Let's say a, a customer has walked in the Samsung's showroom where they are selling both the traditional as well as this new green washing machine as well. Let's say customer had no idea about this new product. The customer only wanted to buy the traditional washing machine. Walked into the store. The customer looked at this green washing machine and decided to buy that green washing machine. That means there is a hypothetical loss of one traditional washing machine, right? Which the customer wanted to buy. But since now the new product has come up, now that customer is preferring the green washing machine over the traditional washing machine. That means there is a cannibalization which is happening. The company has to keep a track. As long as it is benefiting to the company at an overall level, it is uh, it is good. They can live with that. If that is not the case, if they are selling more new products at the expense of the older products, and if that is say not that profitable at a company level, in that case company has to rethink their strategy, right? So that is nothing but cannibalization. Next is growth plan or strategy. Here, the client is a surf apparel company that has the 3 stores on the west coast of the US, is looking to grow its store base significantly across the continent. The CEO would like help designing a store rollout strategy across North America, right? Simple case, the company is looking to expand from 3 stores on a western coast to the rest of the country. So what all are the factors we should factor in? First, we need to identify changing customer preferences or demands and respond accordingly. So people and US geography wise, it's really huge, right? They are having multiple time zones. So people who are living in the say western coast, with the cities like of your LA, all the cities in California, right? So people living there, their preferences, the company can't assume that those people are having whatever preference that they have. Say somebody living in New York on the say eastern coast, even those set of people would have the same preferences, right? So if you are an apparel company, in that case, you have to factor in the preferences of people living in the respective geographies. So that's something company need to understand before rolling out the new stores. They also need to understand uh, uh, they sort of have to reformulate the marketing strategies, because the marketing strategy which is working for the three stores in the western coast is probably not going to work for the rest of the country, right? So you need to go back to the drawing board. You need to come up with a new marketing strategy which works out well across the country, right? We also need to investigate means and requirements to expand distribution channel, right? Because earlier you only had three stores and hence distribution was sort of straightforward. But now, since you're expanding across the country, you need to rethink your distribution channel as well, right? If you're opening the stores, if you're expanding your business to rest of the companies, do you want to open the more physical stores? Do you also want to get into say uh, e-commerce? Do you want to enter into quick commerce, right? Or do you want to sell it using your own website? So there are so many channels, something the company needs to evaluate before coming with an expansion plan. At the same time, the company also needs to understand what is going to be the capacity going forward, right? So earlier you only had three stores, probably one manufacturing plant would cater to all these three stores, but now you're gonna have significant number of more stores, and hence you need to plan your capacity expansion as well. Like, are you gonna have say region-wise manufacturing plants, or are you gonna have one centralized plan, right? So there's something the company needs to rethink. At the same time, they also need to consider uh, how to expand the sales force as well as the customer service. Like, do you want to have a centralized customer service, or do you want to have it at a region level? Do you want to have it in-house? Do you want to outsource it, right? Same goes for Salesforce. Uh, so again, they need to investigate the means and requirements to expand these two areas. They also need to see how to expand the product or service portfolio. Like, is there a new product the people need on the eastern coast, which is probably of no use on the western coast? If that's the case, then they should think of adding more new products in their product portfolio. And lastly, they have to take a decision whether to grow organically or inorganically. Like, if they want, they believe that going forward, growing through an organic route is going to be more beneficial for the company. In that case, the company should open the stores on their own. If that is not the case, uh, uh, then they have to look at the existing players on the other parts of the countries, and they can probably think of acquiring a particular store chain to grow very rapidly, or they can partner with they can sort of form a joint venture, and then that's another way of growing your business, right? So you have to really decide whether to grow organically or inorganically. Whichever may be the case, you have to again be doubly sure what is the strategy going forward, considering everything, like the capital allocation, that the that investment of time, resources. So there's something that the company needs to figure out. Next is market entry or expansion. Here, the case is the client is an online yoga apparel retailer looking to enter the European market. The CEO would like help in formulating an entry strategy. Right? So there are companies selling the yoga apparel products, and they want to enter into European market. So here we need to understand these three aspects. We have already covered market landscape and competitive dynamics, but we are going to focus on the entry strategy piece of it. But as an overall, if you're given this engagement as a consultant, you need to factor in all these three things. For entry strategy, these are the things that one should be mindful of. First, what is the approach to entering? Again, the same discussion that we were having for the previous case, whether to grow organically or inorganically, right? So whether to open its own website and selling the yoga apparel products through a website on their own, or even within the organic category, do they wanna sell their products using say e-com platforms like your Amazon? If not, then do they wanna tie up with say another European company, right, who can act as an importer on record, seller on record? Uh, Another way could be they can say acquire another existing company based out of Europe. So that is another strategy. At the same time, they also need to figure what is going to be the time which is gonna be invested uh, in both the approaches. What is going to be the investment required for both the approaches? Are there any regulatory approvals which are required? Let's say if you try and acquire a local company, so that's something the business has to factor in. They also need to understand what is the customer mix. Let's say this yoga apparel company is based out of India and they are looking to enter into European market, right? So in India, their target customer may be the end users, the individuals who are doing yoga. But in Europe, that probably the case would be can be different, right? It may be the case that in say one of the European countries, people are the yoga industry is say more organized. If that's the case, then people may prefer buying the yoga apparels through the institutes, whatever institutes that they are a member of. If that is the case, then your target customer would be those yoga institutes and not the end users. So and that varies from industry to industry, country to country. So that's something you as a business you really need to understand what is the customer mix for a particular business and for a particular region. At the same time, the company also needs to understand the product pricing. For that, they need to understand what is the existing level of pricing in that particular market or region. And at the same time, all the factors that we had discussed in the pricing optimization, they have to factor into their fully loaded cost to produce goods or services. They need to compare it with the competitors' pricing, right? And how sustainable is that going forward? Something they have to decide. Next is M&A or JV. Here, the case is your client is a European online white goods retailer that is considering acquiring a North American online furnished retailer, right? So you're already selling white goods like your fridge, AC, and now you're expanding your business. Now you want to enter into furniture space, and in order to enter that business, you are acquiring a company who is already into furniture space, who's based out of US. So which are the factors that you should factor in? First, you need to perform the target company specific analysis, right? So once the target has been finalized, we need to perform that company specific analysis. And for that, we need to factor in these aspects. First, the market position. Like, is our target the market leader? Where do they stand vis-a-vis the competition? What is the level of customer concentration that the company has? Like, is it the fact that let me give you an example. I think uh, it has been recently in the news that Delivery is acquiring e-com. right, in the logistics space. And one of the drawbacks for ecom is the fact that ecom's 50% of the revenue comes from one single customer, right? And that is suspected to be Meesho. Now, Meesho is thinking of coming up with their own logistic arm, right? And hence, there is a very significant risk of losing, say, half of the business for ecom. That means their customer concentration is very high, right? If that is the case, then one should, very carefully assess a target. So that's something one need to factor in. What is the customer certainty, right? So if you are having 100 customers, how sustainable is that? Like, or what has happened historically to those 100 customers? Is it the fact that your customer churn is very high? That means you are, although you are adding more customers, but at the same time you're also losing a lot of customers. If the customer churn is high, then it's a red flag. What are the company's supplier relationships and supplier certainty? If the supplier relationships are very good, in that case, the company holds the power to negotiate rates with the supplier, the favorable terms that they are able to agree. If it's not the case, then it's again a red flag. What is the barriers to entry? If the barriers to entry is very high and the company's the target is already operating in that particular space, that means the target has an edge. If it is not the case, then it's anyone's playground, right? Anybody can enter into a market, that then that's always gonna be a risk, and hence the company has to factor in that particular risk. What is the reputation or brand loyalty? If the brand loyalty is very high for that particular target, so that's one of the green flags. There's something the company has to factor in. Are there any product related, regulatory related, tech related risks at a present level, also going forward? So that's something the company has to assess. Secondly, we also need to compute the expected profitability resulting from a transaction. May it be an acquisition, JV, whatever may be the mode. So we need to calculate what is going to be the payback period, the net present value, internal rate of return, right, based on the current operations and growth estimates. That way, you're gonna be knowing that, okay, in say, for example, what time I'm gonna get my money back, whatever amount that I'm investing in order to buy a particular target, in how much time I'm gonna get the money back, which is nothing but your payback period. We also need to add in the cost or revenue improvements from the synergies, right? So now the company is say operating in the white goods category, and they are buying the furniture player. There may be a limited synergies here, but it may be a fact that the supply chain, which is the company already has, uh, and once they acquire this particular target, they can leverage their existing supply chain or the supplier relationships to get the contact for the relevant suppliers for the newer target. If that's the case, so that's a cost synergy. That means I'm able to reduce my logistic costs going forward using my existing company's capabilities. So there's nothing but the synergy. We also need to subtract out the integration and restructuring expenses, right? So whenever a company acquires another company, there's a significant chunk which is getting invested in order to integrate both the companies, right? And when I say integrate, you need to integrate the systems, processes, people, right? And that's a very huge cost. So we need to factor in that integration cost as well. And then we need to see whether acquiring that particular target makes sense or not. Because if my all these integration and acquisition costs are very high, and if my expected synergies are very low, in that case, it doesn't make sense for me to acquire that particular target. We also need to compare with similar projections. If company were to endeavor to grow organically, right, we need to see that if the company is not acquiring this particular target and the company is opening a store on its own, here in this case, if it's online furniture retailer, if the company is building the website on their own, what is going to be more profitable? right? What is was going to be more lucrative for the business is something they have to factor in. We also need to estimate synergies. Here we need to see what is the company's ability to combine or leverage joint distribution channels across products produced by acquirer or target, or something we were discussing just now. The how to leverage the existing supply chain for the newer acquisition as well, right? If that's the case, then there's a very high synergy. What is the value of expanding geographic market reach? So here, the European company has bought an American company, though the product areas are different. One is white goods, the other is furniture, but that gives the existing company an access to a new market altogether, right? The company was already existing in Europe, but now they are already and they also exist in US, although in different product area. But they, since now they are having a presence in US, they can also think of selling white goods in US as well, right? So that gives the value of expanding the geographic reach. What is going to be the cost synergies, such as spreading overhead costs across a larger combined business or combining redundant IT systems? For example, now whenever two companies are coming together, they would be having their own central support teams, which are finance, legal, IT, HR, right? So they'll be having all these functions, supporting functions for both the companies. But now, since the uh, transaction has taken place, you no longer require to have multiple support functions, right? So there also lies an opportunity of synergy, right? If let's say total 100 people are there in each companies for these support functions, finance, IT, HR, legal, right? But now going forward, you don't need 200 people to run those functions, right? Or you probably only need say 150. So that means there's this cost synergy which is there. That means you no longer need those cost of those 50 people. You can let them go, and hence there can be a cost synergy as well, right? Next is startup or early stage venture. Here the case is Rohit, a student from India at Harvard University, has determined that there's an enormous opportunity for Indian style desserts in the North American market. He's in the process of securing funding to produce the dessert in Oregon, and would like input regarding the key considerations for the dessert to be a success, right? Straightforward case. So what all are the things that one should keep in mind? So there are two legs to it. One is the market landscape, and that's something we discussed at length. The other is business plan. That's where we are going to focus now. So first, what is the product or the service? What are the pros and cons of this product? And how does this compare with the existing product in the market? So our product is the Indian style sweets, right? What are the pros and cons of this product? The this particular student has to understand, if this product is getting launched in the US, what are the pros and cons? Like, are people uh, going to prefer this product or over the other existing products? Is there a risk of say complete rejection from the audience, right? So you need to figure out what are the pros and cons for a particular product, and how does this compare with the existing products, right? So maybe the competing products could be the so the Middle Eastern sweets are also very popular, right? So probably that would be the substitute products, and obviously you have the other competing categories, which is ice cream. So how does this compare with the other uh, similar level of products, if not substitutes? Who is going to be the target customer? So say if this is a student, is he targeting the Indian origin people in the US? Is he targeting only the say university students? Is he targeting say the entire Asian population, right? So what is the target customer set? what is the core distribution channel? Like, is he going to sell it online? Is he going to sell it, say, using the say campus canteens, right? So that can be one of the distribution channels. What is going to be the marketing plan? Like, is he going to say sponsor the say university campaigns or events or sports or festivals, right? Or is there any other marketing plan this particular Rohit has in mind? So that's something which needs to be fed in for this business plan. We also need to understand what is the initial funding requirements prior to the cash flow break even. How does this compare with the expected future profitability? What is going to be the projected revenue cost for say 3-5 years horizon? So that's something which needs to be assessed, right? So that will also give out an idea that how much funding which is required at a seed level. So which is very important from a business plan perspective. From management and oversight point, who is gonna run the business? Like who is going to be, let's say, the CEO for this particular company? If Rohit is going to manage this entire company, in that case, how much time he would be able to give to this particular business, considering his studies as well. Who is going to be the investors? If there are, and then this actually plays a very critical role, right? If you're bringing in an investor who has already invested in a similar sort of startup previously, they do have a successful track record. That is very crucial for these sort of startups, because they can leverage their existing expertise. They can give the very valued feedback to this particular startup, and that can be very critical, right? So what is the investor profile is something which needs to be assessed, right? So yep, that's it from me. I'll open the floor for any question that you guys may have. Anyone? Yes, no, we are good. Pratik, Prashant, Hasanul, Rajesh, are we
Yes,
good?
Mahesh.
Yeah, good.
Yes, yeah, it's very good.
Cool, cool. Chalo, okay, cool. There are no question. We'll bring it to the close. So thanks everyone for joining in, and have a good rest of the weekend. Thank you.
Hello, Mahesh.
Yeah, go ahead.
Actually, I have questions regarding if as far as the MA is concerned. Now we are seeing that the edutech industry, basically, the PW is acquiring some other organization. They are basically giving the coaching and the civil service examination, like Drishti and others. This edutech industry is doing this right now,
Hmm,
so that if the client is coming from edutech,
hmm,
what we have to approach to do, because too much industry is going on currently, and too much competition is right now.
hmm,
So that what is the if someone want to enter into the market, in this industry, basically,
hmm,
what should be the approach we have?
hmm. So standard consideration is something we already talked about for in the market entry framework, right? So all those factors that one should factor in. But continuing with the same example that you're citing, I think there's very high uh, 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 competition concentration, right? You have a handful players who are holding significant amount of market share in this particular industry, and to begin with, you don't really have a lot many players in this particular space, right? It is getting crowded very recently, but if you see the market potential for India, it's still considered that you have very limited number of players existing in this particular industry. So, right, so that's something, one factor that one should keep in mind. Secondly, the consolidation level, if you see in the recent years, so many transactions have happened in this particular space, right? Akash got acquired, and then Baiju was on an acquisition spree. They acquired so many companies, right? So if the consolidation level is very high, in that case, there's also an opportunity for new players entering into the market of getting acquired by say bigger players at a very good sum, right? So that's also very lucrative opportunity for somebody who's thinking of entering into this particular market. And more often than not, many founders opt for those sort of equation. They are ready to sell off their business to bigger players, and hence they always look for such opportunities, which is the potential of which is very high in this particular space. So these would be a few considerations that one should keep in mind, other than the standard consideration that we just talked about in the case framework.
Okay, thank you very much.
Yeah, no worries. Okay, thanks everyone. Thanks. Bye.
Hi, Mahesh. I have a small question.
Go ahead.
We have seen the frameworks, we have
Yeah.
seen various cases,
Yeah.
but my expectation would be may not be very right or something. But my expectation was to solve the case with respect to the frameworks that you have mentioned. I could understand the cases, I could understand the nuances of the factors that you have put in, but applying the frameworks to solve something and get a conclusion was something which I was looking in today's class.
Right. So two things. First, yeah, sure. No, that's very valid expectation. First of all, in the
Yeah.
beginning of the
Because
session only,
understanding the
let
cases,
me
knowing the
complete.
factors and all, like myself at an experience of over 30 years
Yeah.
with MBAs and other things. So understanding all these things is absolutely fine. But my purpose was to apply the framework. Like we have 4 frameworks we mentioned it initially, could be the big one or the other 3 one. So how do we apply the framework and try to get some conclusions out of it and solve a case? Like that was something was my expectation.
Right. So two, three things. First, in the beginning of the session only, I had made it very clear that we are not going to solve any cases, right? We are going to focus on the approach part of it. Second, the sort of different level each candidate is in this particular forum is very different. Like for example, you are having you're so much experienced professional, but we also have somebody who's a fresher, right? So catering to each unique need of each individual would probably not be very pragmatic, right? We also need to
No, Mahesh,
yeah,
I don't agree to what you're
let
saying. Even if somebody is a
please let me
fresher,
complete,
he will be
Rajesh.
getting the
Yeah.
explanation and then
I
following.
I heard you now. Probably it would be really helpful if you can listen to me, and then you can share your views as well. So yeah, second was each student is having their unique needs and requirements and expectation, right? So we can't probably cover to everybody's unique expectation. Third is the fact that for this particular session was from the case study round perspective, right? Where the most important part of it is the framework or the approach, right? How do you approach a particular case study is super important, right? It may be possible that you practice say 100 case studies, but as long as you are not thorough with the approach, it is not structured, it is going to be of little use, right? In my particular personal experience, approaching a case study is most very crucial, right? And hence the entire objective of this particular session was to make the students understand about how to approach a particular case, right? And hence there's a separate session just for understanding the cases, the approach, the framework, how structured it should be, what are the considerations that one should think of. And hence we covered the 8 types of case and frameworks, right? This was the overall objective, to make the candidates understand about the frameworks and approach. That was the whole objective. Now I appreciate that you are having the expectation of solving a case study, which is also fair. I'm not saying this is something out of the context expectation, right? If that is the case, I would appreciate that you take it with the Grow Junction SPOC. I'm sure they'll respond to your expectations accordingly, right? Probably I'm not the right person, but I thought I would probably explain the intent behind today's session, and for your expectations, you can reach out to the Grow Junction SPOC. Works?
Got it. I have nothing more to say, sir.
Sure.
Thank you.
All right. Thank you. Bye.